Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. I'm Art Alvarez with Mortgage Works, where we have the answers and they're on the house. I want to go ahead and jump right into giving you an interest rate and bond market update because I have good news in this relatively cool day in the Coachella Valley. We're only about 110 according to my phone. Here's our rate grid, and you'll be happy to see that we've got rates looking pretty darn good. Conforming loans, Fannie Mae, Freddie Mac, FHA, VA, we're either in the low sixes, or FHA, VA now we're in the fives. FHA, for example, at 5.75, had a nice little bit of improvement today, getting us back to frankly where we were just a couple of weeks ago. And of course, the story there is all about the 10-year Treasury bond yield. That's a good benchmark to use to track where rates are going. Had nice improvement today. And what that had to do with, and there's the chart right there, have a little bit of an uptick. This actually got down to about 418 earlier this morning, but you can see there on the right side of the chart that nice kind of cliff right off straight down there. That's how the market opened today. So what would cause that kind of abrupt improvement in that yield? Well, it all has to do with inflation numbers. This week, the economic calendar actually was relatively light. And we started off the week with Chairman Powell speaking before Congress. That was on Tuesday and Wednesday. And his comments did provide a little bit of enthusiasm to the markets. For one, he basically declared that they're not going to wait to get to the 2% inflation target before the possibility of rate cuts. So the market, of course, embraced that as good news, that they're not going to wait all the way till we hit 2% before a rate cut. And of course, because of that comment, the probabilities, the betting markets in terms of when is the first rate cut going to occur, that appears to be bolstering the belief that we might actually get a rate cut in September. Now, again, if we do, it's not going to be dramatic. It'll probably be 0.25% in the Fed funds rate, but heck, every little bit helps, right? Well, of course, what really happened was today. Today, of course, we had the release of the CPI. That's a consumer price index. It was forecast to be flat or lower in June over May. In fact, the forecast was 3.1% year over year, down from 3.3% in May. Well, guess what? The CPI actually came out this morning lower, the first time since 2020 that the CPI number actually decreased. It was actually a minus 0.1%. And that year over year number actually came in lower than expected, not 3.1%, but 3.0. So that's what gave the market some real good celebration today. The bond yield, again, improved by about 10, 12 basis points from the low point this morning over what it closed at yesterday. And then the balance of the week, just Friday, tomorrow, is when we'll have the PPI. That's the producer price index. That's inflation at a wholesale level. And that also is forecast to be flat in June over May, where you can see in June, it's forecast year over year to be no change. And for June, the year over year is forecast to be flat, which basically means the same as what it was in May of 2.2. So we'll see if that does bear out tomorrow. If those numbers are as forecast or lower, then that could add some additional fuel to improve bond yields and therefore mortgage rates. So all in all, pretty good week. Happy to see this. This again reiterates the fact that we're in the sixes. We're now in the lower part of the sixes, high fives for those Govy loans. I'm telling you, no point at this point, in my opinion, wait any longer. If you're still kind of hovering about whether or not to buy a home, I think there's a good time to do it. Now is better than later. Get in a game before rates, actually before home prices go up further when rates do come down. So again, good news on the inflation and the interest rate and bond markets. So with that, I'm going to go ahead and bring Jeff back because we're going to talk a little bit more about reverse mortgages, a couple of aspects of them that maybe is not quite fully understood by most senior homeowners. Hi, Jeff.
Hi, Art. How are you doing today?
Doing all right. Enjoying our relatively cool weather.
Yeah. Well, the other thing is, it's exciting when you can share some good news. I know there's a point where it wasn't always good news, but you were able to find some good news in the pile of rubbish, it seemed like. So congratulations. It's like we just need a little shot in the arm to turn this whole housing market and loan around. And I think today we're going to talk about something that, hey, people don't have to wait for it, right?
Right, that's correct. Yeah, reverse mortgages are altogether different when it comes to the need for the product and where mortgage rates are. I mean, that's a factor, but they're not quite as preoccupied with rates when we're talking about the reverse mortgage product and how it can help homeowners.
Well, we want to get into these today because, there are many different types of products that you offer that are available. And sometimes it can be a little confusing. And the goal today is to clear this up. And really, it's like, a HECM. Somebody hears about a HECM and we're like, what the heck is that? And so we're looking forward to you sharing that. And also, hey, is there a fixed or an adjustable rate mortgage? We were fearful of those back in the 2010s, 2008 about adjustable rate mortgages, and that got things in trouble. And I want you to share, how that's different now. So if you're ready, I've got a few questions for you.
Oh, sure. Yeah. Fire away. Yeah.
Fantastic. Well, the first one is, let's just get into the right one. Fixed rate and ARM rate options. What are they?
Well, when it comes to a reverse mortgage, and by the way, in terms of that term HECM, just to remind everyone, HECM is an acronym. That's Home Equity Conversion Mortgage. That is the official technical name of the core reverse mortgage product that is used throughout the country. And a lot of folks even today still don't realize that the HECM reverse mortgage product is an FHA product. It's administered by HUD, the Department of Housing and Urban Development. So just understand that's what a HECM is. Now, a HECM first mortgage, you're going to get basically two options in terms of loan type. You can get a fixed rate loan or an adjustable rate loan. Now, on the fixed rate side, it's not like a traditional 30-year fixed rate loan, so to speak. It's not like when you get a traditional forward mortgage and you apply for that 30-year loan, you've got fixed interest rate, fixed payment for 30 years. The HECM does work a little bit differently in the sense that if you decide you want to get a reverse mortgage, the amount you're going to get is going to be based on a combination of your property value, your age, as well as what's called the expected rate, which we'll get into later, I think. But once that's established, then you have to decide how you want to access those funds. One option is to access the funds with a fixed rate reverse mortgage loan. Now, that actually is not done as often as you would think, even though overall, when it comes to first mortgages, forward mortgages, fixed rates by far are of greatest demand. Not so much with HECM reverse mortgages. Part of the reason for that is both with the fixed rate option and the adjustable rate option, when you are getting a HECM reverse mortgage, there is a limit to how much you can access the first year. The limit is 60% of what's called the principal limit. The idea there is to avoid problems that occurred in past years where a HECM borrower would get all of the money available all at once, lump sum, and then run into financial problems being able to maintain the property, both in terms of expenses, taxes, insurance, maintenance, utilities, and so forth. So a few years ago, the program was tweaked to limit how much you can get the first year. And with a HECM fixed rate loan, oftentimes that limit will be hit. And the important thing to understand with the fixed rate HECM option is it's a one-time deal. In other words, when you get that loan, and if the fixed rate lump sum amount that is available is sufficient for your needs, then the borrower may take that option. They get that lump sum amount, and then they're done. There's no ability in the future to like pay down the loan if you choose to make payments, because again, you don't have to. That's the whole focal point of reverse mortgages. You don't make payments. But if you want to, thinking you can pay down the balance and then somehow reaccess that original principal limit amount, that's not allowed. It's a one-time lump sum distribution, and that's it. And then the rate's fixed for as long as you're in the home. So in a lot of cases, the fixed rate option is not as popular because of that limitation. Now, with the adjustable rate option, and the one that we use most often is a adjustable that is a monthly adjustable with a 5% life cap. The nice thing about the adjustable option is more flexibility, because you don't have that one-shot lump sum distribution and that's it. Again, you are still limited to that 60% limit the first year, the first 12 months. But if the total principal limit available to you is more than that, then the beauty of the adjustable rate mortgage option for the HECM is that You can take whatever amount you want in that first 12 months. You can take all the way up to that 60% limit or some portion thereof. But then the rest of the available principal limit amount is still available to the borrower after that first 12 months. And then you have the added flexibility of a multitude of ways of accessing that additional money after the first 12 months, either through a line of credit that grows over time, fixed monthly payments over a specific term, or fixed monthly payments for lifetime, also known as a 10-year option, or a combination of all three. So as a consequence, we do find that the HECM adjustable rate loan is by far chosen more often than a homeowner looking at the fixed rate option.
You talked about a couple things in there, but I want to really target one specific question before we go further. Who is this ideal for, Art? I mean, we talk about, you call it a HECM. We've heard it as a reverse mortgage. Who is this absolutely for? And what does that look like that says, hey, you're a perfect candidate for this?
Well, a perfect candidate really, well, there's a couple things about that, and that's a good question, because there's a few sort of gray areas there. I mean, certainly, the obvious thing is to say, okay, you're a homeowner, you're over 62, you're a candidate. Well, maybe. A lot of it depends on where you're at in terms of existing mortgage debt on your home. Because just being 62 isn't the full story. I've had many cases where I'm contacted by somebody who's over 62, so they think, aha, I can get a reverse mortgage. I've got this mortgage I have on my house now. I'm starting to have trouble handling the monthly payment. I'll just get a reverse mortgage, pay that off. I don't have to make payments anymore, right? Well, not always, because when you're just at that eligibility age of 62, yes, you're eligible, but whether or not this is going to benefit you is all about how much do you owe on your home now. So the best candidate is not someone who's 62 and their loan balance is like 40% of their home value. Because believe it or not, if you're only 62 and you've got let's say it's $1 million home and you owe 400,000 and you decided you want to get rid of that 400,000 because you're 62 and you're now eligible for a HECM, probably not going to work. Why? Because the available loan amount is going to be less than that 400,000 on your existing mortgage. So the best candidate really is someone who's over 62 at a minimum, but it's even better if you're well over 62 and you have very little to no mortgage debt on your property. That's where you're going to be best positioned to take full advantage of the HECM reverse mortgage product and all of the benefits it has to offer. Because again, depending on the value of your home and your age, and the older you are is better, because that'll help establish a greater amount of proceeds available to you.
So let's just peel one layer back at a time. And the whole idea about the age. So if they're 62 and they have, either 40% or no debt on the home, because of their expected life expectancy? And so they get a lower amount because it's going to take, they possibly could be receiving funds for a lot longer, or is there some other reason?
No, exactly right. It has a lot to do with your life expectancy. It's all about actuarial tables. People are living longer now. So if you think about it, let's say you're 62, you're now eligible and your home's free and clear. That may be a good scenario to go ahead and pursue a reverse mortgage. However, what I usually find is the homeowner, especially when they're on that lower end of the eligibility age spectrum, are oftentimes disappointed when I show them how much proceeds are available to them. Again, using my $1 million home example, let's say it's free and clear and you're 62 and a half and you're applying for the loan, and we put together a proposal and we send it to the borrower and they find out they're going to get $250,000. I'm like, wait a minute. I mean, my home's worth $1 million. I can only access $250 out of $1 million. Well, what it has to do with is, remember, a reverse mortgage is probably the original negatively amortizing loan. The loan is going to grow over time, because if you choose not to make the payments, interest and the mortgage insurance is going to be added back to the balance every month. It's going to grow. And well, if you're 62 and you end up living to 85 or 90, that loan amount is going to grow substantially over that period of time. Thus, it's necessary to kind of reduce the amount available to you if you're on that lower end of the age eligibility threshold. So that's something to keep in mind when you're considering this product.
Well, I think that makes much more sense. So if someone's out there listening, they've just turned 62 and they have a large portion of their equity tied up in their current mortgage, they're probably not your best candidate. You want to think about that differently. But if they are, let's say they're 65 or 67 and they have a situation where they're now using that $1 million home, are they a much better candidate if they have no debt on that home?
Well, I think so. And part of the reason for that, again, and as we talk about this, what I'm going to explain really is going to have more to do with what we just touched on, using the HECM reverse mortgage, but using the adjustable rate option, not the fixed rate option. So yeah, let's say you're 65 and you own that $1 million home, it's free and clear. While on the one hand, the amount of available proceeds may be a little disappointing to the homeowner, because again, I don't have an example right here to show you, but let's say it's 300,000, and they might think, well, that's less than what I wanted, but and they may have a need for some of the funds right away, but not necessarily all of that 300,000. The beauty of the reverse mortgage in that scenario, the adjustable mortgage option, is even for a borrower who's relatively at that younger age, 65, they're eligible, is they can take whatever modest amount they need within that 60% limit the first year, and then the rest of that money, the rest of that 300,000, the most common thing done by that kind of a homeowner is they'll set up the rest as a line of credit. And that line of credit, remember we talked before, it grows over time. The unused portion of that line of credit grows over time. And it grows at effectively the current interest rate on the loan plus the mortgage insurance expense of 0.5%. So right now, what that means is if you're 65, you've got a home that's free and clear, and you decide you want to at least have the ability to access your equity set up and ready to go for future, getting a reverse mortgage, even when you're relatively that young, and maybe for that loan amount, and you don't need most of that right away, set up that line of credit. And over the next 5, 10, 15 years, if you're not using that line of credit, you're not incurring interest costs, for one. And that's growing over time. So, within 5, 10, 15 years, that 300,000 may be 500,000, 600,000.
Because the equity is growing in the home at the same time, so that and you haven't access to the whole amount. Is that correct?
Correct. And when we put these proposals together, they typically will involve some assumptions. And one of the assumptions that are used to help demonstrate for the homeowner the increase in the loan balance that's going to occur after they get this loan, it's going to be compared on one piece of paper, the increase in your loan balance from the HECM reverse mortgage, but also the expected increase in your home value. And they use a pretty modest 4% average appreciation rate. So we're not using something crazy like, well, our current home appreciation rates have been running 6 to 8%, and we've been talking about, right, for the last year. So for the reverse, the HECM reverse, the disclosures use a much more modest, conservative 4% average appreciation each year. And what those show, this document will show, is that for the first 5, 10, 15 years, in most cases, the homeowner's equity is actually growing despite having gotten the reverse mortgage. That's something that actually surprises a lot of homeowners, is that you might actually see an increase in your equity even after you get one of these. Now, eventually, if you live really long time, like you're starting to be up the, past 90 and approaching 100, then that'll start to change. But overall, you're going to be in pretty good shape in terms of maintaining equity and even increasing it in certain scenarios.
Well, let me ask you, when it comes to the adjust rate mortgage, how is the rate determined? Because, that first thing, when we hear about adjustable rate, there's a little bit of concern with that, but really, should we be concerned, and how is that determined?
I don't think, adjustables always are more of a concern to a homeowner. That's just a given. But a couple of things about it. First of all, in terms of the HECM reverse mortgage adjustable rate option, the rate is determined pretty much like any traditional adjustable rate loan. It's going to be tied to an index. The index used for these is a 1-year CMT. That's 1-year constant maturity treasury index. Right now, that value is at about 5.05. And then when you're getting a reverse mortgage, you're going to want to ask about the margin. What margin is going to be offered to you, because the margin is going to be added to that index to set your initial rate. And we originate reverse mortgages using a 2.25% margin. You will often find originators of this product will offer 2.5%, 2.75%, even 3% margins. We don't do that. I think that's a little too high. I would caution reverse mortgage prospective borrowers to pay attention to that part of any disclosures they get, because as you go higher in margin, of course, that means over time your rate's going to be higher. And just a little clue, folks, that also can mean more compensation to the originator of the loan. So, we try to stay away from that. So we use a 2.25 margin. And with that current index value at 5.05, that means initial rate right now is about 7.3. Okay. So that's what sets the rate. And of course, these adjustables adjust monthly. And layered into that, there is a life cap of 5%.
What does that, what does that mean, life cap?
Well, what that means is over the life of the reverse mortgage, however many years it's in place, with that 5% life cap, the rate will never be higher than 5% of the initial rate at the time the loan closed. So if we're closing this loan today at 7.3, then over the life of the loan, even if rates continue to go up, that 1-year CMT index starts to go up. If it goes past 12%, you're going to be capped at 12.3. It'll never be higher. That's a pretty low life cap, and I think that's good because it helps protect the homeowner in terms of worst case scenarios. Now, I actually think, and I don't always like to, and we've talked about it on the show before, I'm not a big believer in timing the market, but I would argue right now, getting a reverse mortgage using the adjustable rate option, which is probably going to happen anyway because of all the other flexibilities available to accessing your funds, we're at a peak here where it's expected rates are going to fall. So if you're getting a reverse mortgage now, that might be good timing, because if it turns out the Fed does start lowering the Fed funds rate and they end up doing it multiple times this year, and they're talking about 3 to 5 times next year, well, that adjustable rate on that HECM loan is going to start to go down. So that's going to reduce your interest costs. It's going to reduce your accumulation of the loan balance because of the interest adding back. So I think from a timing perspective, getting reverse mortgage with that adjustable feature is maybe not a bad thing. It might actually be very good timing.
Smart, very smart. Hey, one more question here. For adjust rate mortgages, what's the difference between an expected rate versus an initial rate?
Yeah, that is a question that comes up almost all the time with reverse mortgages. Again, especially the ARM loans, because the expected rate, initial rate really is not applicable with the fixed rate option HECM. So what is the expected rate? Well, when you look at the disclosures, like the one I'm working on now, the initial rate is pretty simple. The initial rate is simply what I just described. It's the current index value, the 1-year CMT, 1-year constant maturity treasury index. Again, right now about 505, plus a margin that we offer 2.25. So your initial rate right now is about 7.3. Okay, and that's what's going to be. That's the basis of the interest accrual back to your loan. Now, the expected rate, which is on the disclosure, and they're showed side by side, it usually gets the homeowner pretty excited. Like right now, the expected rate, with the example I'm giving, is about 6.45. And they'll look at that and they'll say, well, expected rate 6.45. Does that mean that over the life of the loan, it's expected to drop and get more into the 6.45? Well, not exactly. And as a consequence, it can be a confusing subject. The expected rate is an entirely different formula that's used to help determine the amount of proceeds that you can get. At any given time, HUD sets a floor on these HECM reverse mortgages. Right now, the floor that HUD has set for the HECM reverse mortgage is about 5%. So then what they do is they use this formula that has a different index, not a 1-year CMT, but a 10-year swap index, whatever that is, adds a margin to that, and then that is calculated, and the result is then compared to the HUD floor rate. Well, right now, that other formula that again is only used as a computational tool to decide how much you're going to get in proceeds, that formula right now is coming out at around 6.4. And what that means is why it's relevant is the higher the expected rate over the floor rate of 5, the lower the proceeds you're going to get. So what you want to see is that expected rate dropping and getting closer to the HUD floor rate of 5, because as that occurs, and if you're happening to get the reverse mortgage at that time, then you're going to get more proceeds than you would have otherwise if that expected rate was still elevated at 6.4, or even worse, if it went up higher to 6.7 or 7% and so forth. That'll start to diminish your proceeds. So the expected rate, in summary, and I know it's all kind of complicated, is simply a computational tool used to determine what the maximum amount of proceeds you're going to get, combined with your age and your home value. But it is not the rate that is predicted to be on the loan in the future. It's not the rate that your interest accrual is based on. That is going to be determined by your initial rate. That's what your interest accrual is going to be based on. So they're entirely different, and that's why they can be, a little bit confusing when you're looking at your disclosures.
Is this process for getting a HECM, a reverse mortgage, is it a lot different than qualifying for a regular loan on a home?
It's a lot different in qualifying, yes, because we don't qualify the borrower using, as we've talked about on the show before, the ATR rules that are been in place since 2010 with forward, first mortgages. ATR, remember, everyone, is ability to repay. That's an acronym basically to describe the process of where we're going to document people's income and liabilities and assets, and we're going to calculate their ability to qualify based on determining a specific debt ratio, income to debts. Reverse mortgages don't work that way in terms of qualifying. You're not qualified based on a debt ratio. You're not qualified based on a minimum credit score. You do have to provide documentation on your income, on your liquid assets, but that is used in a different way for what's called a financial assessment to basically determine if you're going to have enough wherewithal between your monthly income, between the money you have in the bank, to maintain your property related expenses, taxes, insurance, HOA dues if applicable, as well as maintenance and repairs on the home. So that's how you're, essentially qualified for the loan. That's what the financial assessment is all about. It's not about debt ratios. It's not about minimum credit score. And if it's determined that you have income that's limited and liquid assets that are limited enough to the point where it could jeopardize the quality of the loan, then that's where the LISA will be triggered. That's life expectancy set aside. That could be triggered where money is pulled out of the proceeds and set aside to help maintain those property related expenses, because it was determined at the time you got the loan that your financial profile wasn't quite strong enough to be able to handle that on your own.
Well, Art, thank you so very much for really peeling back this layer like an artichoke to find out, hey, where is the heart of the matter? It really was really beneficial. I put your information on the screen for people to contact you. You can call Art at his number 760-969-5023 and get your questions answered about the loan. And with that, Art, I'm going to dive out of here. And again, thank you so much. I really appreciate it.
Okay, thanks, Jeff. All right, everyone, let's go on to, let's finish up here with our closing question from last week. And actually, this was from 2 weeks ago, because as you know, we had a sort of a abbreviated session last week during the 4th of July holiday. Here's the question. I heard an interesting term recently when discussing real estate and a home purchase. What is a situational buyer? Well, that's an interesting question. And let me go ahead and give you what I thought was a great quote. So I have to give attribute for this. That's why it's in quotes. There is situational based life, which is, irrespective interest rates, driving people's housing choices, and all of that being equal, people want to own versus rent. What that means is, despite the difficulty in the market right now, high home prices, high interest rates, there's still activity out there. And a lot of that is driven by these situational buyers. These are people who, despite the environment, despite the current conditions, they have a need, they have a motivation to buy. The most common ones we're seeing right now is having to upsize because of family reasons. I've got more kids. Excuse me. Employment relocation. Maybe you got a job offer, you got to move cross country, cross state, across town. And there's always still investment property. I mean, that's a little different situational situation, given the fact that some people are still out there buying homes actively, not so much because they want to live in them, but because they're real estate investors, or they want to get into real estate investment. And that can create motivation even in these current conditions. So that's what is in part driving our current market, is these situational buyers who have a need to go ahead and purchase a home now because moving is a necessity. It's not a choice. They have to move. And so the one thing, advice I would give folks who are in that situation is try to focus on the payment. Don't get too caught up on the interest rate. Interest rates can be kind of emotional. I would say, like buying a car, focus on the payment. We can help you with that. And of course, we can help you with ways to get that payment down, as we've talked about many times with tools such as temporary buy downs. And the reason why, and if you're in a situation where you have to move because it's a necessity, not a choice, embrace our current rates. We can help you with that. Remember the old term, date the interest rate, and then the future refi opportunity, which we all think is still coming, will help you then refinance that loan into a lower rate so you can maintain even better expenses for having that home as you go further into the future. When I read this, when I saw this question, I thought to myself, I would also want to point out there are situational refinance borrowers. What does that mean? Well, even in this current environment, refi activity is next to nothing. There's nobody, virtually no one out there who's refinancing their mortgage to lower their rate, because everybody's already got a lower rate. But there are situational refinancing that is usually going on even in these high rate conditions. Now, in most cases, they're going to be cash out refis. Again, who's going to try to refi now to lower their rate? They already have a low rate. So in a lot of cases, the refis going on now are cash out refinancing, except for, of course, if you have an existing ARM loan. Excuse me. Another scenario with refinancing is you're buying out a co-owner of the property. This most often happens in some divorce scenarios where one spouse wants to stay, the other one wants to leave. So this one spouse is going to buy out the other spouse so they can go their separate ways. That's a situational refinance scenario. Or if you own a property with family members, siblings, and maybe, again, one or a couple of siblings want to keep the home, another one doesn't want to. There are refinancing scenarios, transactions going on where you're buying out a sibling. This also happens kind of related way, inheriting a property. When you're inheriting a property, you could maybe refinance the loan because you want to get it out of the previous owner who's passed away, get it out of their name. You don't want cash out. You might still refinance as what we call a rate and term, or you might be looking to pull cash out after you've inherited the property, which again, that's a situational type refinance scenario. Investment property, also a lot of real estate investors out there with property with a lot of equity. So some of those are looking to refinance even at current high rates to try to get more capital to grow their real estate investment portfolio. Now, the other one that's really starting to kind of percolate and become more prevalent in our market is existing ARM loans. Homeowners with existing ARM loans. That's going to become a significant situational refi scenario, I am predicting. There's a lot of ARM loans out there that have adjusted upward, and in some cases by quite a bit. So that is a special case where if you're a homeowner with an ARM loan, maybe you've had it for several years, and for several years you enjoyed very low rates on that. Well, that party's over. Those ARM loans are starting to go up quite a bit. That's a situational refinance borrower. We'd be happy to help you with that, help you get out of that rising ARM loan and get you at least at a ceiling level in the sixes, and then wait for that refi opportunity coming up in the next year or two as overall rates come down. So a good question. That's what a situational buyer is, as well as a situational borrower is if you're looking to do a refinance in the face of these high interest rates that we've been experiencing now for a couple of years. So with that, I'm going to go ahead and close with our closing question for next week. And this is a one we actually run into from time to time. Here it is. Can someone get a mortgage to buy a home if they don't have a credit score? Well, guess what? That is possible. And I'll tell you how that works next week when I give you the answer, and it'll be on the house. So with that, I want to go ahead and conclude our Mortgage Minute program for this week. I want to thank you all for watching and listening. Please stay cool out there, and look forward to seeing you next week on another edition of Mortgage Minute. I'm Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.